Thanks for joining us. We're here today to talk about first quarter market and strategy update. I am joined, per usual, by Mike Green, and we also have a special guest with us this quarter, Jason England, who is our fixed income strategist. So I'm going to do a little bit of a deep dive on the fixed income markets, just given some of the rate volatility and relevance in some of our strategies in that part. So thank you guys so much for joining. I know there's been a lot going on in the markets, and we're headed for a long holiday weekend here, so appreciate your time live. Per usual, we will start with a bit of a macro update. And Mike, I will kick it off over to you to start us off here in a moment. I'll share my slides. But as a reminder, we have a Q&A, which we'll get to at the end of today's call and maybe even address some of it throughout. So the button's in the bottom. Please submit questions throughout. And then as a reminder, this is not investment advice. So thank you all for joining. And Mike, I will kick it over to you.
All right, fantastic. All right, let's go ahead and jump to the next slide. All right, so the most disappointing thing about this quarter is if we go back 3 months ago, everyone was certain that the U.S. election results would bring optimism and growth. The U.S. exceptionalism was the headline. We saw a surge in small business optimism spiking to a 50-year high. And higher interest rates and growth expectations from the economic front clearly supported those expectations. If we look at the impact that that had on flows in the next page, one of the metrics that I track, and I've highlighted this a few times, is the percentage of transactions that are occurring at the ask. So effectively, if you go in and you aggressively bid to buy something, you're going to end up buying that at the price that people are offering it to you as compared to the mid or the bid. This is measuring that. You can see that we just went off the charts. If I can extend this back for about 15 years, we literally have never seen anything that looks like this. This was the single most concentrated buying activity in U.S. equity markets that I have ever seen in the broad ETF space. That's been echoed by other Wall Street strategists, particularly on the sell side, who've highlighted the dynamics of flows. But the very simple analysis is going into January, it couldn't have been more bullish in terms of expectations. Let's jump to the next slide. One of the key components was that the use of levered vehicles. So these were entities that are effectively buying 2x exposure for every dollar that you were putting in. Those took the place in many ways of the traditional use of margin debt that has been a strong indicator of prior economic cycles. I somewhat facetiously note that this is just a great thing because replacing one risky thing with an even riskier thing has never backfired in financial history. I shouldn't say it should say bump, but you can see with the red overlay, this is effectively looking at the fraction of levered funds that are bullish versus bearish, that we saw a phenomenon very similar to what we saw in 2021, I'm sorry. That played out to an even greater degree this time around, and it's really been a portion of the unwind, in particular of these levered funds, that has contributed to the speed and ferocity of the sell-off that we've seen so far. Remember, if you have a margin account, the market has to fall pretty far before you experience a margin call. In levered vehicles, that rebalancing occurs instantaneously. Basically, anytime the market pulls back, they are forced to rebalance by reducing their exposure. In my opinion, this was a key contributor to the speed of the sell-off that we saw, which is one of the fastest in history. Let's jump to the next slide. The key variable has clearly become uncertainty. This is an echo of what happened under Trump tariffs 1.0. The policy uncertainty, in particular around global trade, has exploded to levels that are far beyond what we saw in 2018. I just want to highlight that one of the key differences in this Trump administration versus the prior Trump administration focused on tax cuts and on basically juicing the economy in the early stages. This time around, they possibly have taken a page from Ronald Reagan, which is to introduce the bad news first, effectively giving them economic conditions that they hope that they can blame on the prior administration. We've heard that very clearly in the conversations from Treasury Secretary Bessent. He's indicated that by and large, the economy is going through a difficult period as it removes itself from the stimulus that came out of the Biden administration. Whether this translates into economic growth going forward or from what level that economic growth occurs, we simply can't know. What we do know at this point is measures like the Atlanta Fed GDP now suggest that they have stabilized with a fairly significant negative GDP print of around minus 2.4%. That's very clearly setting stage for conditions under which we would expect economic earnings coming from corporations to be disappointing. We've seen that with things like Nvidia's guidance, which is directly tied to the China tariffs. We really haven't seen it yet in terms of lowered estimates, though, coming from Wall Street. So until we see that, I'm still very concerned about the exposures that exist within the equity markets. And we just emphasize, well, I'm not going to show the slide on it, that we have actually seen flows come into equities. Retail has continued to buy, even as systematic strategies like CTAs, vol control, hedge funds have sold positions and delevered for the most part. Let's go to the next slide. The really key thing to understand is that when volatility increases, there are many systematic strategies that have to respond. Their value at risk, or what's called the VAR ratio, rises. And if you think about what value at risk is doing, it's taking your expected return and it's effectively saying what is the drag that is being created or the additional risk that's being created from volatility. If volatility goes up, the arrow's in the wrong place, by the way. It should be against that sigma sign. It basically looks like a young child with its hair sticking out on the far right. When volatility goes up, your expected return per unit of risk falls. As a result, you're forced to delever positions. Again, largely what we've seen has been systematic. The discretionary move from retail continues to be for inflows. All right, let's go to the next slide. What's driving that sentiment in terms of concern across the economy, the falling levels that we're seeing from the University of Michigan or the Conference Board in terms of sentiment? The quick answer is that we don't really know. It does appear that there is a tremendous amount of concern that is being expressed in a political framework. So Republicans are much happier than Democrats. Democrats are much happier than communists. Communists are much happier than nobody. But the unfortunate situation that we're following right now is that the economy is weakening. We have seen unemployment start to rise. What we have not seen yet are claims, and we saw an exception to that in the federal worker initial claims that came through. I didn't include the chart. I didn't have time to include it because we just got the data today. We couldn't get it through compliance. But I encourage people to look at the relationship between things like the Challenger and Gray announced layoffs relative to unemployment. I put a tweet out on that a couple of days ago through Tier 1. The really key thing here is that we have seen a spike in layoffs from Challenger that is accompanied that every other time has been accompanied by a significant jump in claims over the next month. We'll see if that's going to be the case, but as we can talk about in just a second, let's go to the next slide. It really does all kind of come down to jobs in this framework, because if you're a believer in my passive flow component, if you are employed, you are participating in a 401k. That 401k participation means that your paycheck, a portion of your paycheck, and your employer's contributions are flowing into equities and to a lesser extent bonds. What I'm showing on the right-hand side is the relationship between the labor market surprises and the S&P 500. There's just a very close fit. It's on a leading basis. We've continued to retreat here. This suggests that the S&P is likely to move further below its 12-month average. The only good news about that is now that it is below the 12-month average, that 12-month average is falling. And so at some point, this starts to reverse itself. But again, I just think we have to be very cautious in jumping ahead of ourselves and interpreting this incredible event that has added such uncertainty into the market. Let's go to the next slide. And this is the point that I would emphasize on unemployment, is that the introduction of the gig economy, which really didn't exist in the way that it does today until 2012, when Lyft joined Uber in the car dispatch market. Remember that Uber, when it was introduced in 2009, was a black car service. It was taking people who are already driving and providing them with an additional source of income. In 2012, when Lyft entered the market, they gave individuals the ability to drive their cars and provide services in exchange for additional income. That was a big breakthrough. It led to UberX. And this is really the first quote unquote recession in which we are able to see, or potential recession, in which we're able to see this type of impact. In the immediate aftermath of COVID, you couldn't drive Uber because nobody would get in your car. This time around, we're seeing a dramatic uptick in the utilization of things like the gig economy. In men, it's flowing through to things like Uber and DoorDash. There's a natural experiment we can run. About half of the states in the United States do not allow those under the age of 25 to drive commercially. If you may remember when you got your first job and you tried to rent a car at the airport, you are unable to unless you were part of a corporate plan. This is a reflection of the same underlying thing. And so by comparing the unemployment for the 16 to 24 category versus other employment categories, we can get a sense of the magnitude of this. That's that blue line relative to the orange line in the chart on the left. We are a full standard deviation above in terms of the unemployment rates for those who are not eligible to drive for Uber versus those who are. This is really important. On the right-hand side, there's a different impact that tends to hit the women's employment market. In this case, about 85%, so about 75% of Uber drivers are men, about 85% of influencers are women. And it is amongst that group that we're seeing the explosion in full-time employed with a part-time job. I just want to emphasize that that second part-time job, due to revisions in how we calculate it and what's incorporated in there, is now if you make a minimum of $600 a year, you become employed as an influencer according to the BLS. I personally don't consider $600 as full or even part-time employment, but I don't get a vote in the matter. What is important about this is it is depressing claims for the very simple reason that filing for unemployment stinks. You have to file for unemployment. You're going to get a very pitiful remuneration. The state of California, which I happen to know reasonably well, your maximum benefit, regardless of how much money you were making before, is $450 a week. And you're only eligible for 26 weeks. And in every single week, you basically have to show your unemployment officer that you are meeting the obligations in terms of your parole. I'm sorry, unemployment terms. When people realize how much more money they can make on a cash basis for driving the car that they already have, or popping onto their iPhone or laptop to do a post, which they may receive some compensation for, they rapidly discover that this is probably a better solution. In many ways it is. It's great because we'd love to see the private sector step in ahead of a government solution. But there is a very important difference. In a recession, unemployment benefits gain in value because everybody else loses their purchasing power. Uber and influencers are the opposite, unfortunately. More people flow into the system, the supply overwhelms demand, prices fall, compensation falls, and so it behaves like every other form of employment. Unfortunately, this means it's really not a solution to concerns around unemployment. It is a great thing in our society that we have this flexibility. It is a wonderful innovation, but the fact that the Fed is blissfully unaware of this scares me to death. Let's go to the next slide. But the biggest impact that we're seeing by far in capital markets is capital flight. I just want to highlight this is part of the reason we're seeing the dollar weakness. This is part of what we're seeing in terms of market performance, both on the fixed income side and on the equity side. Harley and I go back and forth around who is selling on the fixed income front, but what we are very clearly seeing is money being repatriated. We gave a very clear message to the rest of the world. You need to invest more. Their response to that has been very straightforward. Thank you. We'll take our money for the bonds back. We'll take our money for the stocks back. As Trump might say, they're eating the stocks. They're eating the bonds. We can now flip to the next page. And this is not the first time that we have actually seen this happen. We saw evidence of very similar behavior in the 22 period. Once the United States took Russia's bonds, China stopped buying. And since that point, we've actually seen tremendous strength in Chinese bonds. Perversely, this is occurring against relative weakness in the currency. The overwhelming question that exists as it relates to China is how painful this is. How much is the dollar shortage that is beginning to emerge impacting? I'll talk about it a little bit in CDX, ways that we're exploring ways to protect our portfolios against this. But this is really kind of the key thing that we have seen the capital markets fragment. If you are going to rebalance trade, the capital balance becomes, the capital flow becomes a possible solution to this. And it looks like they're taking advantage of that. It's more extreme than that because the US runs a trade surplus in services. We have focused on the goods component. The only math that really makes sense in that is if you're going to balance the goods component, that means you are forcing your trading partners to either access the capital account or reduce their consumption of services. Overall, that speaks very negatively about the potential for earnings growth in the United States. And is that my last slide? I think that's my last slide, right? Yeah, let's skip this one. This is not a big deal. On the inflation front, Powell's emphasis on imputed prices, which he began to introduce in December, I think is really, really important. Part of what he is telling us at this point is that the construction of CPI, and to a lesser extent CPI, are what are actually causing us to see elevated levels of inflation. I just came from the grocery store. I was shopping for Easter. I too see that egg prices are higher. I'm very disappointed to see that milk prices have risen a little bit, etc. We are seeing some of this flow through again in price pressure, but it is nothing like what we saw in 2020 and 2021. And if we use real-time metrics of inflation, this is effectively taking Powell's guidance, substituting things like owner's equivalent rent, which is a 3-month moving average for inflation in the rental space, and replacing that with things like the Cleveland New Tenant Rent Index or the apartment.com index or the I'm blanking on the name of it, the core metrics that also feed into the S&P components. We get much lower inflation numbers, as I'm showing here, using the Cleveland New Tenant Rent Index in place of the imputed owner's equivalent rent. We're already well below 2%. Again, I recognize that your grocery bills are going higher. I'm not arguing that you're delusional or anything else, but we are broadly seeing an environment in which the inflationary pressures have been ameliorated. Unfortunately, having achieved that success, we're now introducing tremendous uncertainty around tariffs. And I would just like to highlight that effectively what we have entered into is something very much like the COVID shock, where we shut down the world with uncertainty around what happens next. You can kind of think about where we are, at least this is how I'm thinking about it, as we are in the 2 weeks to flatten the trade deficit. It's now, unfortunately, in roughly 3 weeks. It looks like it's going to extend a lot longer. In other words, lockdowns are here to stay for a while until we hear otherwise. You should expect very similar behavior and a lot of confusion around this. Let's go to the next slide. You're seeing inflation expectations surging. I just want to make sure that everyone is aware that part of what is going on here is a substantive methodology change. So if you actually look at the composition of things like the Michigan inflation expectations or many of the other metrics, they switched from a telephone-based survey in which you're talking to a human being. And if you're really, really angry and you're really, really frustrated, you're likely modulating yourself to a certain extent for the very simple reason you answered the phone. When you switch to an internet survey, nobody knows if you responded or if your dog answered the survey. And as a result, people are far less restrained in their responses. We actually see this in the volatility of inflation expectations. We've seen an extraordinary bifurcation, largely along political lines, between those who think inflation is going to surge above 10% and those who think that we are back in the Great Depression, potentially even experiencing deflation. You're never going to decide which one you're on until you change your vote. So, we're in a very uncomfortable situation. I just want to emphasize that it is not showing up in the data to reflect these expectations yet. Whether that changes is something we're going to have to decide in the future. As I mentioned, uncertainty is really the critical component. All right, let's go to the next slide. The last thing I would just emphasize, we are very much seeing components of this in our conversations with RAs, et cetera. As the Fed has begun to cut interest rates and as we have introduced uncertainty and volatility into stock prices, the areas of the economy that are getting hit most are actually those that held up best. It's at the high end of the economy. Suddenly, they're experiencing uncertainty in terms of what are their incomes, what are their asset bases. They no longer feel comfortable leveraging up their equity exposures in order to obtain additional cash for consumption. We're seeing very clear signs that there's a retrenchment. And this is, kind of one of these areas that will write the economic textbooks for the next 20 years as we evaluate, did the Fed actually stimulate the economy with interest rate hikes, or did they contract the economy? I think the answer is, of course, it's bifurcated. Those of you who tuned into the KESS episode with Peter Atwater discussing the K-shaped economy, this should be nothing new, but we are actually getting to see it play out in real time. And so I think with that, we'll cut off my section there. We'll hand off to the next.
Great, Mike. Well, I was actually shocked when you said that egg prices were higher than you remember, which means there actually was eggs in the store because I have yet to find eggs at any grocery store in Southern California for the last month. So kudos to you.
Thank you.
Yeah. So as we pivot to talk about some of our strategies, as I mentioned at the onset, we have a bit of a different focus this quarter and kind of fixed income in focus. So again, we brought Jason England on, our portfolio manager and fixed income strategist, to give us a quick background on kind of where we are from a macro perspective, from rates, from fixed income broadly. And then he'll run through a list of, as I mentioned, some of our flagship strategies and also some of the tools we have on our shelf to help our clients understand or at least implement some of their interest rate views. So without further ado, actually, you know what? Let me mention one other thing before I hand it over to Jason. New and exciting. Always like to kick off with what's going on here at Simplify. This past quarter, we launched two new funds, Foxy, which is our currency strategy. We're taking both long and short positions in both developed market and emerging market currencies, with the caveat here being we are US dollar neutral. So this is a great addition to an alternative sleeve and is not taking directional bets on the US dollar. The second strategy that we launched last quarter was our China A shares fund, which has our proprietary income overlay. So representation across market caps in the onshore market for Chinese equities. So excited to have those as our growing list of funds. And as some of our strategies on the shelf continue to grow, continue to build track record, wanted to highlight we now have 5 strategies that Morningstar has given a 5-star rating to. Some of these we've just passed a 3-year track record last quarter. That's our high yield ETF, CDX, as well as our managed future strategy, CTA. And we'll talk about both of those in more detail here soon. So Jason, I'll hand it over to you to give us a little backdrop on fixed income.
Yeah, thanks for the handoff, Paisley. Pleasure to be joining both you today. Obviously, interest rates have been on really a roller coaster ride. I know we're talking about Q1 here, but really to set the stage with interest rates, we got to go back to Q4. And it really started, the Fed cut 100 basis points. And I'm going to reference the 10-year when I talk about rates here just to make it simple. But, the Fed cut 100 basis points across the last 3 meetings of fall of 2024. But interest rates went up by 100 basis points, namely the 10-year. And a lot of that really was the fact that you started to see the election get priced in. And as the eventual result of Trump winning, and there was a lot of uncertainty, and the market started to really price in around the new fiscal policies when you start talking tariffs, immigration policies, and tax cuts. So that led us into really, going into Q1 where you hit a peak level on the 10-year in mid-January, somewhere around 4.8%, because you peak uncertainty. Inauguration didn't happen. Once the inauguration happened, you started to see some of these policies implemented. You started to see a flight to quality, and you saw rates come down. And you came all the way down to about 4.15 on the 10-year in early March. And then rates kind of settled in this range, probably about a 20 basis point range in March, as you really started to see the on again, off again tariff policies, where the 1 minute they're putting them on, then there's pauses. And really that played out through the back half of the quarter. And then we got obviously to our tariff tantrum last week. We got Liberation Day on April 2nd, where he announced new tariffs. They started to be implemented at the beginning of last week. And once you hit that point, you really started to see, rates move extremely, over 50 basis points on the 10-year, over that time frame. And you started to see, the surge was one of the highest we've seen in over 20 years that big of a move in that short of a time frame. So really rates have been on a kind of roller coaster ride, as I said it. So fixed income has become very topical. We have a very diverse fixed income suite here. So I'll start going over some of them right here. The first one is Buck. It continues to do what it's been, asked, the process and philosophy behind it. It's continues to enhance yield above T-bills, over the quarter, producing a distribution rate above 7%. It continues to provide a diversifier in the ultra short bond category, with no credit in it and limited duration. And it's really reached a point now where it was performing very well until obviously, the extreme shock that we saw in rates last week. So really moving into Q2 now, where we saw, the extreme shock in rates put some pressure on the option selling strategies on treasuries. When you see a 50 basis point move in 10-year rates and 20-year rates, as well as seeing the move index that measures interest rate volatility, it spiked by 50 basis points as well. So you really saw a peak there mid last week until the 90-day pause was put on tariffs that really only happened 3 other times in history, with the move index peaking like that. So although the strategy has delivered on its process and philosophy, it did hit a little bit of a shock last week, because interest rate selling on treasuries, when you have a move like that over such a short time frame, it was kind of the worst case scenario. And as I said, it's something we haven't seen in over 20 years. So that's Buck. That's kind of the ultra short. As you walk out the curve, it's the ultra short strategy we have. Next up is our core bond strategy, and it continues to provide a higher yield than the Bloomberg Aggregate Bond Index. It's produced over the quarter a over 7% yield as well, or distribution rate as well, and the index had a 4.6. So it's continued to out yield the index, and also since inception through the end of the quarter, it's outperformed an annualized total return of 1.8% alpha over the index. So it's delivering on the core tenets that we're trying to do in here, is more efficient option writing as well as curve positioning, are kind of the two main areas where we're trying to disaggregate the egg and find the best opportunities in core bonds and fixed income. And while, as I said, the enhanced yield while also maximizing total return. Once again, it does have that option selling strategy. So it did have some extreme stress last week when we saw the 50 basis point move in 10 years, as well as the 50 point move in the move index. So the one thing about these option selling strategies that we believe, when we do get some stability in rates, and you get back to trading in a range, because these are range bound mean reverting strategies, when you get back into that middle of that range, these higher vol levels and higher premiums on the options should provide higher yields in the near term, as well as better total return over the long run. So although they performed well throughout the quarter, we hit a little bit of a headwind here with the extreme rate movements from the tariff tantrum at the beginning of Q2. Obviously this is a Q1 recap, but I felt it was remiss if I didn't kind of highlight those as we talked about some of our fixed income strategies. And rates have been moving so volatilely over the last, like I said, two plus quarters now. So it's good to keep abreast of what's moving in fixed income. Next up we have is our high yield bond fund. And obviously what's different with this one than most is it's got a credit hedge built into it. It continues to perform well over the quarter, with an annualized return over 5.5%, beating the high yield index. Once again, as Paisley mentioned before, it had its 3-year anniversary during the quarter, as well as getting a Morningstar 5-star rating. And the quality minus junk hedge that is the proprietary hedge in there has done really well. Obviously, credit has been somewhat complacent to start the year, but you started to see over the last month or so around a lot of these, the tariffs, and especially when we got the tariff tantrum last week, you started to see some spread widening, and you really saw the quality minus junk credit hedge kick in on there, and it's doing what it's supposed to do. And if you continue to see any slowdown in growth and see widening, because really right now, even though we saw a little bit of spread widening, when you look at high yield spreads in the low 400s, they're still historically tight. So when you do start seeing any credit spread widening off, slowing growth, any type of slowdown in the economy and recession, you would really see them widen out, and you'd see the quality minus junk hedge really kick in even more. I'll hand it off maybe to Mike if he's got any further comments on CDX. I know this is one of his near and dear to his heart.
Well, I appreciate that very much. Thank you, Jason. No, CDX, we're really pleased with how the product has functioned. The hedge, as you point out, has worked very well. As a reminder, what we're doing with the hedge, we have 3 separate ways that we can tackle hedging. We've actually added 2 additional components to hit risks that we think are actually growing. The quality junk is a long basket of very high quality companies. Effectively, you can think of it as companies that never need to touch the capital markets. Against that, we're short a basket of junk companies. Those junk companies are ones that continually need to access the capital markets. As a result, when credit spread widens or the ability to access capital markets becomes significantly more challenging, what we call tightening financial conditions, the quality factor outperforms the junk factor in a predictable fashion, adding return to the portfolio. The nice thing about this hedge is because of those same characteristics, the higher quality companies tend to be buying back their shares. They offer a higher dividend relative to the junk companies, which are serial refinancers and often, as you might imagine, have to do so at inopportune moments. That's creating conditions under which it functions in the same manner as a hedge, but it carries positively. It's been a really key component of strategies I've used for over 10 years at this point. We have augmented that with the ability to use credit default swaps. We occasionally are concerned that quality junk has worked so well that it introduces the potential for what's called basis risk. This is related to the basis trade that you've heard so much about in the news the past couple of weeks. The reason that we will add that, even though it has a negative carry to it, is that it's a direct response, and that also has contributed very positively. I mentioned that we've added an additional factor, 2 additional factors that we can add. One of the key components when Harley created RFIX was it allowed me to add a little bit of duration to the portfolio in CDX relative to what's happening in the high yield space. For me, this is a critical component. The high yield space, because it has not seen a significant refinancing wave in the environment of high interest rates, has seen its duration fall significantly. This actually introduces a little bit of additional risk in terms of the performance of high yield. We've been able to add basically 1.5% to RFIX and a tiny little bit to TYA in order to dramatically increase the duration back towards the historical benchmark for high yield. So we're running at a duration exposure that, give or take, is about 0.7 years more than what we're seeing in the equivalent HYG. The last thing we've done, candidly, drives our market makers a little bit crazy. I've taken advantage of the fact that the currency disruptions have lowered the volatility on on FX options, particularly as it relates to currencies that are pegged to the US dollar. So the Hong Kong dollar implied volatility has collapsed to near the lowest levels in history. It is also trading, or was trading, right at the very bottom of its band. That meant that we could buy effectively an in-the-money call option on Hong Kong dollars and pay basically nothing for it. That has already become a positive contributor to CDX performance. It does make life a little bit more difficult for our market makers who struggle to hedge it, but it adds an additional source of protection in the portfolio. If trade relationships deteriorate further, we anticipate that the next space that you'll see a significant surge in volatility is in FX. we spent 25 basis points to purchase protection for 400% of the notional. That means if the if the Hong Kong dollar peg does break or even just pushes to the top of the band, at the top of the band, we return an additional roughly 50 basis points, which is obviously great. On a break of the peg, the product will deliver a really, really attractive return profile that'll offset the risks that we could potentially see in other areas should the trade tariff war escalate. And so this is something that I'm very happy to have in the portfolio. As I said, it drives our market makers a little bit crazy. It just, again, mandates something I always try to advise, which is don't put on market on close orders into ETFs. You can get taken advantage of by market makers. So with that warning and a quick update on the positioning, I think we can move on to the next.
Yeah, that's a good segue because you mentioned both RFIX and TYA and the use cases that you're using in CDX. So this is, just kind of highlighting we do have a suite of interest rate products that you can express a view. And once again, these are not necessarily Simplify expressing a view, but it's a tool for you that if you want to express your view in interest rates. And as I said, we've obviously seen over the last 2+ quarters a lot of volatility in rates. So people are really, questioning, how do I want to position? How do I want to hedge in my portfolio? So these are 4 different examples of tools that we have out there in our fixed income suite that you can use. The first one is simply TUA, pretty straightforward. We're just buying 2-year futures, levering them 5 times. Underlying collateral is T-bills. And this is, going to take advantage of if you're one of those out there that believe in that the Fed's 2 cuts that they have in their dot plots maybe is less than what they're going to end up doing. And you believe in where the market's been at certain points recently of 4 to 5 cuts and you want to take advantage of it. That's a key benefit of this product. If you see the front end coming down and you start seeing a normalized upward sloping curve. The next one is TYA, and this is pretty straightforward as well. We're just buying 10-year futures, 3 times levered. And you can see we're getting the extra duration there. So you're getting more of a 20+ year duration index that it's matching to, but you're using it at the 10-year part of the curve. So another way to just express a view on the curve in a levered format, very capital efficient way to get that view done. This is, as Mike said, he used some of it in CDX, and where we've seen a lot of end clients want to pair it because they have a view on the belly of the curve and they want to express it in a very capital efficient form. The next 2 products are creations by Harley Bassman. First one is RFIX, and it's basically the bond bull ETF. And if you want to get a way to obtain capital efficient, significant long duration, we're talking, around 40 years in duration. This is a way to express it. And the other benefit here is it's a 6 times positive convexity of the 30-year US Treasury. So what that's telling you is it's getting 6 times the upside than the downside if you're investing. And this is one that has really come into play recently, especially when we saw investors realizing rates had really started to get elevated, as I said, through the back half of last year and into January, where we kind of hit peak on rates before the flight to quality when you started to see tariffs come in. So people, that believe in that kind of higher for longer rate scenario with the Fed staying on hold, which they continue to convey that they're in no rush to cut at this point. But maybe you're afraid you're going to be wrong in that view and you want to hedge on in your portfolio. This is where you've seen people start to use it as just a way to call for a extreme drop in rates over a short time frame in one of these type of hard landing type scenarios. The next one is PFIX. It's been around longer than RFIX. It's just basically the inverse of RFIX, where if you want very capital efficient, significant short duration, somewhere around 40 years, because you feel like rates are moving one direction or another and you want to make a call on rates moving higher. And this is where we saw a lot of people using this back in the the run up when the Fed started to really hike back in 2022 and 23, and really hike more aggressively than I think the market had initially thought, because they were obviously fighting the headline inflation above 9% back then. So another tool where you're seeing, where it's very capital efficient. That's the one thing with all four of these tools. It's very capital efficient to express a view on interest rates, whether it's the long end with RFIX, the short being very short duration in PFIX, and then picking a spot on the curve with TUA and TYA, whether you favor the 2-year or the 10-year. So it's a very robust suite that, like I said, very capital efficient. Yeah, here's some of the returns on them, but it's giving you the tools to make your own view on rates. Like I said, mostly systematically ran, and not Simplify expressing a view, but giving you a tool that you can use in your portfolio to express a view on interest rates. That's kind of the recap of the fixed income suite. I'll hand it back to you, Paisley.
Thanks, Jason. Hopefully that was relevant and timely. As mentioned, we wanted to highlight fixed income just given the shelf that we have, the unique tools that we have that Jason just overviewed. So a lot going on there and a lot of really strong capabilities. I'm going to overview 2 other strategies that we have outside of the fixed income world that I think are really resonating, just given some of the macro volatility, our clients looking for ways to diversify their portfolio risk or ways to think about hedging some of their equity risk, and then we'll address some of the Q&A. So first and foremost, and near and dear to my heart, is our managed futures strategy, CTA. This is one of our flagship strategies. This fund in particular has more than doubled in AUM year to date. And really, we saw a continuation of strong performance in the first quarter that really solidified for many of our clients and investors the role of this as a strong diversifier, and not only just to have a low to no correlation to stocks and bonds, but also to add attractive source of absolute return. So in the first quarter specifically, we saw strong absolute returns of about 6.4%, which meaningfully outperformed its index as well as equities. And you'll see there the chart in the top left, the white line is CTA, and kind of that divergence, especially as we headed into the back half of February. I think something that's really important is that CTA has the ability to rebalance on a daily basis. And as a reminder, we're trading in commodity and interest rate futures. And so like many trend following strategies, we are subject to some of those kind of reversions of trend. And so you'll see as markets started to turn over mid-Feb, we also experienced some of that initial drawdown, but it was the ability of the strategy to reposition, start going into longer term interest rate futures, scale out of some of the commodity exposure with the exception of gold, that allowed us to kind of pivot and then kind of divert from the broader market, which continued to move lower. And so ending the quarter in positive territory and really delivering on our clients' expectations. So just as a recap, kind of bigger picture, we just passed a 3-year track record in March of this year. Morningstar gave us our 5-star rating, which we're very excited about. And since inception through the end of the quarter, we've delivered about 12.25 annualized return. So this has outperformed the S&P 500 over the common inception period and has done so while being negatively correlated to equities. So really strong diversifier, capital efficient, and providing that attractive source of absolute return. So wanted to highlight that. And as mentioned, we've doubled in AUM year to date because I think clients are really not only seeing this strategy in particular as a strong source of portfolio return and diversification, but more broadly speaking, thinking about ways to diversify risks. I think this quarter or last quarter was a strong reminder as to the importance of diversification in a balanced portfolio. And just given all the volatility that we saw in bond markets, as Jason just alluded to, the importance of having kind of that third leg of the stool in a portfolio, and managed futures historically have delivered, and our strategy in particular has since inception.
Before you go on CTA, I actually want to highlight, we got a question just very quickly about mirroring of FX exposure on CTA and Foxy. Currently, CTA does not have any FX exposure. That was a choice that was made in terms of creating the product. We are exploring the ability to add that, but Foxy and CTA stand alone as products in those 2 respective areas. The other thing that's worth highlighting on CTA is some of the recent drawdown that's occurred in CTA has been a byproduct of the rotation that the trend following strategy uses into fixed income. So it's actually echoing some of the components that I'm highlighting in CDX. Effectively, CTA has moved from being negative on rates, in particular at the front end where they had been focused on the risks of rate increases. It is now rotated to a point where it is expressing a long view towards bonds and duration. Just like in March 2023, when there was an extraordinary event, basically a 13 standard deviation move at the front end curve associated with the failure of Silicon Valley Bank, you're now seeing the current volatility there shake a lot of the trend assumptions. But the really key thing, and I talk with Charlie on this on almost a daily basis at this point, is that their models are also suggesting that duration is really the place to be. And so they are firmly in the duration camp right now. That's proven a little bit challenging over the past couple of weeks, but I actually am very pleased to see that their model seems to be reflecting what I would expect it to do and is holding firm on that view, even as others are kind of shaken in that framework. So I'm hoping it has a similar result in terms of the performance that we saw in the aftermath of the Silicon Valley Bank events.
Yeah, no, I'm glad you mentioned that, Mike, because I would say the shift to being in like longer duration interest rate futures and holding long positions in interest rates broadly is a deviation from where CTA has been positioned for much of the life of the fund. So without getting into too much detail, really since inception, just given the inversion of the curve, the model has really signaled there's a negative carry from just like funding of underlying treasury bill collateral. So it's actually been a significant tailwind for performance, especially in the back half of last year when many of the managed futures industry broadly was long on interest rate futures. So now that we've shifted, as Mike alluded to, hopefully capturing some of these tailwinds as interest rates move lower. So shifting gears to one of our flagship equity strategies and thinking about really what's resonating in the market right now, as we've hit some of these pockets of turbulence and equity market drawdown, I think a lot of clients are looking for ways to stay invested, stay the course, but also look at maybe reducing some of the beta and thinking about a more defensive approach to staying in the equity market. So HEQT is our hedged equity strategy, also has a 5-star Morningstar rating. And really the way that we view this is benchmarked to a 60-40 portfolio. So how can we offer greater return than a 60-40 while also offering lower volatility? And HEQT has delivered on that. You'll see in the return table here, thinking about recent performance and its ability to outperform the S&P in the first quarter of this year. And meaningfully outperform kind of more of the core benchmark, which is the 60-40 over the longer time period, especially back to since inception. And most importantly, thinking about shallower drawdowns. So downside protection, thinking about lower volatility. And as a reminder, HEQT is really looking at capping upside. That target is roughly around, say, 5 to maybe 10% upside capped. And that's a moving target based on market volatility. And then understanding that downside protection is really down 5%, and then you're protected anywhere from down 5 to down 20%. So extreme equity drawdowns, say in excess of 20% or more drawdown, there would be participation again, but it's really cushioning the blow and capping downside participation. And so ways that our clients are using this again is to kind of de-risk some of their equity exposure. And if there's intentions around, some of these volatility spikes that we're seeing in the market, higher bond yields, and really not thinking about bonds being your ballast in the portfolio, this can be another way to implement that view and stay invested. As we know, timing of the markets is often a fool's errand. So anything else?
Yeah, before you move on to HEQT, I actually just want to make sure that people are aware, unlike some competitors that do that option strike on a quarterly basis for a 3-month option, which means that you have very different coverage at the beginning of that period versus the end of that period. One of the tools we use in HEQT is a continuous deployment of 3-month options on a monthly basis. So instead of a single strike, it's spread across multiple strikes. That actually has a very positive effect in a drawdown environment because you are actually getting protection earlier. And as we add new protection at lower levels, you're getting protection further down. So it becomes a continuous hedge. There is the key risk to that strategy is when markets, very strongly trend upwards, then we're short some calls more early than some of the competitor strategies, or at least potentially earlier than some of the competitor strategies. And so when you see the sort of leap that you saw in December, that can lead to a degree of underperformance, but we're absolutely seeing this strategy pay off in this environment. We're really pleased to see it doing exactly what we want it to do.
And maybe on that note, as I mentioned, environments where a strategy like HEQT can play a role in a portfolio is expectations for just continued or heightened volatility within the equity market. So I think we would be remiss, and I think some questions maybe came in the chat, which I can't see right now, around one of our other flagship strategies, SVOL. And some of the kind of conditions that we've seen or challenges that we've seen in the marketplace recently. I know we talked about this on last quarter's call, as well, and just thinking about the environment for shorting volatility. So really just thinking about the last couple weeks, the elevation of the VIX curve, kind of the inversion there. And usually what we see is as that curve inverts and as the VIX moves higher, it's usually for a short period of time. We've obviously kind of been in this like status quo environment where we've continued to see elevated volatility that has yet to come down fully. And so strategies that are, selling VIX futures are obviously going to be exposed. SVOL was not immune to that. I think some of the benefit is that some of the positioning that we've put on is then looks attractive going forward as that curve eventually reverts or normalizes. But I would maybe just mention some of the other processes within SVOL. Beyond shorting the VIX, we also have embedded hedges, which include VIX calls. Although this was a prolonged period of VIX, a heightened VIX level and the curve being inverted, the actual absolute level of VIX did not breach kind of those extreme levels that would require those hedges or those VIX calls to come into play. And so some of those were not triggered for better or for worse, but really looking through like a risk managed approach and balancing. And this has been a goal of ours for the last several months as we've made some enhancements to the strategy and thinking about risk focused approach is although this is an income generating strategy, we also are prioritizing NAV to ensure that there's not the erosion of NAV, which is very important to our clients. Mike, do you have other comments or thoughts that you would share beyond that?
Hold on one second. I'm turning on my calendar. I apologize, everyone. I'm having problems with my display, and so I'm trying to make sure that I don't overburden everything.
We thought you were just bashful today.
Yeah, no, I'm red in the face. No, I mean, I think that's right. Look, this has been an extraordinarily difficult period for short volatility ETFs. SVOL has disappointed us relative to what we had hoped to accomplish there, but the key component has been that elements of those hedges have started to kick in. There is higher sensitivity. We will be reevaluating it and looking at it, but at its core, you should expect during periods of high volatility that the product does experience drawdowns. And as that volatility retreats, as hopefully it will, I obviously don't want to have the forecast that it's going to, particularly given my other concerns. We want to get benefit from the knowledge and the experience that we've come through, and two, we are well positioned to recover in the event that we start to see volatility retreat. So that, unfortunately, these are challenges that exist in these types of environments, and very much like a COVID type environment, we saw an unexpected radical shift in the volatility profile of the equity space, and that has impaired SVOL at this point. It maintains exposures, has managed itself as systematically as possible through this, and it provides a learning opportunity and the opportunity to earn some of that back as volatility retreats.
So those were our prepared remarks. Jason or Mike, anything else that you would like to speak to or mention before we jump to Q&A?
I think that's it. I mean, obviously, I'm very pleased and very disappointed in the quarter and some of the subsequent behavior. anytime things work well like CDX, we obviously want to celebrate that. When we experience challenges, we also want to make sure that we're very clear in explaining what has transpired, what we expect going forward. Hopefully we'll be able to continue to do that. We always appreciate the faith that people place in us by putting their dollars to work at Simplify.
I can't see the Q&A from my screen, so Brian or Mike, if you guys...
I can read a couple of them. Jason, this is one that's directed at you. Why is Buck's duration currently reported at 4.48 when the objective states that it will maintain a duration of below 1?
Yeah, so on average, it's always going to try to maintain the duration below 1, but obviously, as I mentioned, the spike in the move index of 50 basis points last week really brought the option selling strategy into extreme pressure last week. And so as we started to risk manage that, we've widened the strikes of the options, which we believe should make it safer. And then we've also replaced some of the options with futures, as the hedging in options is currently very expensive. So it's a temporary um, you know, hedging process that, as we saw the worst of the worst last week, and we were trying to manage that downside move as you saw it. And so, like I said, this is, the worst case scenario for an option selling strategy on treasuries when you get although our options are short dated, 1 to 2 months, when you see a move over that quick of a time frame, just several days of 50 basis point magnitude on rates, then you continue to have to manage and move your strikes as well as protect downside. So it's kind of the process that was done last week we've obviously seen rates retreat a little bit this week, and it has helped. So that's, a near-term movement of widening the strikes and doing that to benefit more downside or to protect more downside.
Yeah, what I would emphasize on that, effectively what Jason was saying in English, is there was a de-risking within the strategy reflecting the higher level of volatility. The other thing to really remember, though, is that when you measure duration, you're talking about a move in the interest rate, not the interest rate volatility. And in this case, the realized volatility in the significant move in rates that occurred in the aftermath of Liberation Day. I only say that in half air quotes. We liberated the treasury curve is kind of the easiest way to think about it. But what we actually saw was a coordinated move in a jump in volatility, which adversely affects Buck at the same time that we saw a directional move in rates. That shows up as measured duration, even though the actual duration itself is not really measured in that way. So it's just saying the sensitivity of the fund to the direction of the move in interest rates was correlated in a way that would suggest duration exposure, but the fund is not actually exposed to the duration per se. Is that a fair assessment, Jason?
Yes, that's saying it in plainer English and not bond geek math like me, but so that is a fair assessment.
All right. Let's see. Next question. PFIX or RFIX, both to create a straddle-like structure to handle the rate volatility that could continue. If both, how to wait? This is a Harley special.
Yeah, this is a Harley special, and he's not on, but I'll try to.
Is this where we can phone a friend?
Actually, Harley is on. I think he's dropping in questions on Q&A to tease me. He hit me with a question on interest rates versus inflation. For those of you who are following the Q&A, Harley asked me, when am I going to agree that he was right on interest rates? And if you remember my arguments with Harley around inflation, he refuses to concede on that, and so he's apparently moving the goalposts. All right, go ahead, Jason.
Yeah. So to answer that, I guess, that wasn't the initial launch of, they've obviously spread out several years. PFIX was more the setup then was, remember, the Fed was sitting in the zero bound and had to start increasing rates. So a negative duration, significant negative duration product made sense back then. Now that we've kind of, reached a peak in rates, or I guess we won't call it a peak, but we saw elevated rates coming off of the election results and that. And I said they did peak out on the 10-year at, at the mid-January. So then there was more the thought process of, okay, higher for longer. Maybe you want this extreme, significant, long duration product. If the rates start coming down, the Fed has to start easing a little more aggressively than what they've done so far, and you see a hard landing scenario. So the reason for the launch of both products weren't necessarily to pair them together, but we are running scenarios now of pairing them together. And if you want to reach out to your Simplify rep, we can have those conversations. And I'm sure get Harley on, and he will discuss it pretty thoroughly, and I can be on those as well. But that wasn't the initial intent, but we are seeing now, pairing them together is something people have asked us about. So we start running scenarios around that.
Okay, let's jump to the question from Joel Wittenberg. You liked MTBA due to the flat curve. Is it still the trade after this widening? It's a really good point. So the key risk in MTBA is that because what it's buying is the new issue mortgages at higher yields, those are subject to refinancing risk if interest rates were to be cut significantly. One of the arguments that I tried to make very clear at the start of that was that I actually expected MTBA to be able to hold on to its positions longer. In other words, its effective duration was going to prove far stronger, in part because of my concerns about credit exposures. So while the TBAs themselves, the mortgage products themselves, are issued by the government is securing them. The actual mortgages themselves are underwritten against the individual credit. And so what we've seen, unfortunately, emerge is a significant deterioration or risk to deterioration in household credit metrics. This is both a function of the FHA coming clean on their modification programs. It's also a function of student loans coming back on. Roughly 9 million 9 million individuals, approximately 4 million households, are heavily exposed to the repayment risks associated with student loans. Many people treated in their budgetary expenditures as if those were going to be expunged. They certainly have not been. What that means is that if you go to refinance and your credit has deteriorated, you actually are probably not going to get a better interest rate. And many of the new home buyers who use the mortgages that were issued at high levels, it's tremendously unfortunate, but their credit scores were inflated by COVID era adjustments in reporting, mitigation procedures, et cetera. That means it's going to be far harder for them to refinance those mortgages at attractive rates. We just had John Tuhig on Keeping It Simple. He notes that if you had managed to take full benefit of the student loan and the FHA components, you could have taken your credit score from 550 to 700. Moving back to a 550, which would be as simple as missing a payment on almost anything in your profile, which would drop you down into the low 600s or to the 500 range, could result in you going to refinance your 7% mortgage and discovering your new mortgage is somewhere in the neighborhood of 12%. That's not likely to happen. And as a result, those are probably going to carry on longer than we would have otherwise expected, consistent with the initial hypothesis. I don't see a key reason to change that perspective.
I know we're a little bit over on time. I think there's maybe one or two more questions in the chat.
Yeah, there's a question on FIG, which both you and I are involved with Paisley in terms of performance during the volatility spike. The challenge here has been twofold. One is that there has been an element of protection measures that were purchased, purchased in particular out of the money puts. We funded those in some situations by using components of our income overlay in which we had sold put spreads in order to finance other sources of protection. Because we saw such a coordinated decline in a variety of spaces, that actually meant that those put spreads went into the money before the kick in from the tails fully manifested itself. That's what you saw in terms of the drawdown and the acceleration of the drawdown, and then the very rapid reversal. Effectively, as the market reversed, we saw that we got that back. It worked better in FIG than in some of the other products. But again, this is going to be one of these areas where we're going to spend a lot of time, dissecting what transpired, what we can do better, et cetera.
Great. I think those were all the questions. I know we're over on time and it's a shortened day for most people,
Yeah,
going into
get
the
off
long
to
weekend.
get
So
off to the long weekend, everyone.
yes, Jason, thank you for being our special guest this quarter. Mike, thank you as always for your macro comments as well as your comments on our respective funds. Thanks everybody for tuning in, and we look forward to seeing you guys again next quarter. And we have a lot of exciting stuff going on, so make sure you're following us on LinkedIn, make sure you're on the newsletter, some new fund launches coming down the pipeline, and some more webinars and media presence here. So thanks everybody for your time today, and we look forward to working with you.